Now, while global growth remains well above recession levels, all regions are negatively impacted this year and next. And the global disinflation process continues, but at a slower pace, with inflation revised up by 0.1 percentage point in both years. These trade tensions will greatly impact global trade. We project that global trade growth will be more than cut in half, from 3.8% last year to 1.7% this year. The tariffs will play out differently in different countries. For the United States, the tariffs represent a supply shock that reduces productivity and output permanently and increases price pressures temporarily. This adds to an already weakening outlook and leads us to revise growth down by 0.9 percentage point to 1.8%, with a 0.4 percentage point downgrade from the tariffs only, while inflation is revised upwards. For trading partners, tariffs act mostly as a negative external demand shock, weakening activity and prices, even if some countries could benefit from trade diversion. This is why we have lowered our China growth forecast this year to 4%, while inflation is revised down by 0.8 percentage point, increasing deflationary pressures. All countries are negatively affected by the surge in trade policy uncertainty as businesses cut purchases and investment, while financial institutions reassess their borrowers' exposure. Uncertainty also increases because of the complex sectoral disruptions that tariffs could cause up and down supply chains, as we saw during the pandemic. The effect of these shocks on exchange rates is complex. The tariffs could appreciate the US dollar, as in previous episodes. However, greater policy uncertainty, lower US growth prospects, and an adjustment in the global demand for dollar assets are weighing down on the dollar. Risks to the global economy have increased and are firmly to the downside. First, while we are not projecting a global downturn, the risk it may happen this year have increased substantially, from 17% projected back in October to 30% now. An escalation of trade tensions would further depress growth. Financial conditions could also tighten as markets react negatively to diminished growth prospects and increased uncertainty.